Right. Okay, welcome everyone. As I see participants and all of our attendees coming in, as everyone starts to come into the room here, we have a very interesting and educational conversation we're going to have today. It's on critical KPIs, top 5 things to track in your financials. My name is Shaylin Scott. I'm the Executive Director of Founders First CDC. We're a nonprofit that is nationally based that helps diverse-led small businesses grow and expand their businesses to serve their communities. A big part of our focus is not only education, but providing access to connections, community, and capital. And so in order to do that, we want to make sure that you have all the tools and resources available. So one of the ways we do so is through our webinars like today. And we have a very talented group of people here from a lot of different perspectives. We have Patrick Rodriguez, who is the business banking lender and dedicated relationship banker for First Citizens Bank. We have Manish Dedragia from a wizard of E2M, full stack white label digital agency. E2M is the company, and Jessica Z. Hornbeck, outsourced CFO, COO, bookkeeping services for big picture results. So we have a wealth of knowledge here today that will talk about key things to track in your financials. So we'll start as we see a few more people rolling in. I'll give you a little bit of time. Now, keep in mind, if you have any questions, at the bottom of your screen, there's a Q&A section there. So you can put your questions in if you have any that we do not cover. A lot of you have already provided questions when you registered, so we'll try to get through as many as possible at the end of the presentation today. We have a few minutes to have everyone to do their presentations on their area. So we'll speak to an expert when it comes to the finances, what to look for, key things to track, and how the best methods and tools to use. We'll talk with Patrick, who will talk about the funding from traditional lenders. What are they looking for? What makes your business a good fit? And then we'll speak to Manish, who is a business owner who has received funding because of his impeccable finances. And so all of those different perspectives will help you as you try and fine tune your business and get all the resources as well too. So without further ado, I will start with Jessica Hornbeck and allow her to take the stage. You're on mute, Jessica.
Hello, everyone. I am excited to be here today to talk about financials and KPIs. Long story short about me, I'm a Latina, grew up in the Bronx, raised by old world Cuban woman. I come from very humble beginnings, and I worked really hard to build a life for myself, repeat entrepreneur. I spend a lot of my time with clients digging into financials, but making them more approachable in discussing money mindset. What's your approach? Making sure that we talk about any limiting beliefs, things that might hold us back from seeing and thinking a bigger picture for ourselves. Today, we're going to run through financial statements, how we can tie those into KPIs. Nothing to be scared of there. They're just a fancy word for metrics. Then I'm going to segue the conversation briefly into attracting outside capital so that I can turn it over to Patrick, who's going to discuss the importance of getting yourself in shape for attracting from a lending perspective. If we could go to the next slide, for some reason it's not allowing me. Perfect. So the beginning tool that we're going to refer to in building out our KPIs is going to be something that we're all comfortable with, right? Profit and loss or an income statement. Quick and dirty behind a P&L. It is the story of the operations of your business, what you're doing in order to make money and generate hopefully some profit. The key contributors to that are going to be your income, so what you're selling. Cost of goods sold are your variable expenses. The quick way to remember the difference between your variable or your cost of goods sold versus your fixed expenses are a cost of goods sold or variable expense is a function of you making money. So you're not going to have those unless you're making money. Very different than your overhead, right? Those are those costs that even if you don't have a customer coming in the door or going online to buy your product, you're still on the hook. So these are going to be rent, certain insurances. So it's really important to differentiate between the two types of expenses. When we're looking at cost of goods, for instance, after you take into account your income, you're going to end with your gross profit. That's going to be one of the largest or most important KPIs or metrics that we have to keep our eye on. And we'll talk about that in just a minute. So if we go to the next slide, this is going to be another sort of cut off of your initial P&L statement. We can build out either projections by looking at some assumptions. How are we going to generate more income in the future? Hopefully, if you're taking into account economies of scale, it doesn't cost you that same amount of variable expenses to make that dollar of income. You should sort of realize a decrease in your cost of goods. The same way that we're going to build out projections over the next few years to either get yourself in a position to attract outside capital. It can be part of your business plan. It should be a management tool so that you can get a feel for, is this business going to be a moneymaker? Should I stick with it long haul? Or are there things that I should cut sooner than later? It needs to be as practical as possible, especially when you're meeting with a lender. And I'm sure Patrick will talk to this more. Your projections aren't the time to be overly optimistic. So yes, you want to see a bigger picture for yourself and be somewhat optimistic, because that's going to sort of add some fuel to your fire to bring more revenue and customers in the door. But you don't want to be overly optimistic that it's not achievable. And projections are not the same as your budget. You can create from your projections either monthly budgets, quarterly budgets, and I recommend that you build those into your accounting software so that anytime when you're looking at your financials, in this case, I'm looking at the full year 2019, you have a basis of comparison, right? So if you look at versus prior year, how did I do? Am I growing versus the year before, the year, 2 years before that? But also, how am I doing versus budget? And if you're looking at it with that perspective, okay, we're hitting budgets or we're far off or whatever, you need to do that in tandem with looking at your metrics to understand, well, what's the underlying cause? Whether you all of a sudden are dropping off in the amount of leads that you're converting into customers, or maybe you're just not attracting enough because your marketing efforts have gone down, or maybe it's a matter of you spending too much. So getting in the habit of looking at your financial statements. We're going to look at the balance sheet in just a moment. P&L, balance sheet, and metrics. You need to get in the habit of looking at all those together. We're never going to understand the full picture if we're looking at just the P&L, because the P&L just looks at your operation. Whereas we'll look at the balance sheet in just a sec. That talks about the overall health of your organization. This picture here looks at annual projections. If we can go to the next slide, if you build out that P&L with, and I want to touch on the balance sheet in just a sec. And in the meantime, if you can think about this question, why it's important to look at both. With regards to building out your KPIs, you will build out that P&L with a monthly trend, and that's going to build out your KPIs. Before we move on to that slide, your balance sheet, very different than your profit and loss statement, which just looks at your operations. Are you making money? Where are you losing money? Where do you need to cut? Your balance sheet looks at the overall health of your company. And feel free to chime in, Patrick. It's super critical from a lender's perspective to understand, is this business well capitalized? Or are they overly leveraged? And these are all items that feed into your KPIs, right? Looking at your liquidity ratio. How much do you have in the bank? Your cash flow, is it healthy? When we're looking below the asset section where your cash lives, maybe you have equipment, right? So that's your total assets. The balance sheet equation is always going to be this basic accounting formula. Assets, so those things that you own of value, equals liabilities or equity, meaning they got paid for either via liabilities, borrowing, right? And we all know the standard form of borrowing is going to start from credit cards all the way to loans, whether they're short term, long term. Maybe you borrowed a lot. That's the case for startup businesses, right? Or for some of us, we funded the businesses by bootstrapping our own personal pocket, right? Maybe we had savings. That's going to show up in the equity section. Maybe you have outside investors. A really great way for businesses to raise capital is to form as a corporation so that they can then issue stock or shares in their business, which is just a component, a portion of their business. In exchange, they give stock issuance to investors. That's a great way to attract outside capital. Very different than lending or borrowing. But it's important to look at your balance sheet because you determine how to finance their cash and their assets. Are they predominantly borrowing and they're on the hook? Or are they on the hook to somewhere else, not lenders? They're on the hook to investors. And the reason we need to look at both of these financial statements in tandem, the P&L and the balance sheet, because you could have a great P&L where you're profitable and you're making money all day, every day, right? Like that's not a problem. But when we look at the balance sheet, and if you're overly leveraged and you owe to this guy and that guy, and then this person owns, 60% of your business, that dictates the rights to those profits. So you could be a very profitable company and bringing in lots of money, but you have to look at the balance sheet to determine who owns the rights to those profits. And that's why it's critical that you look at both. It's a very junior mistake to show up to a meeting with stakeholders, maybe your team, to discuss the financials and show up with just the profit and loss. That's only one piece of the formula. You have to understand, well, who is assigned the rights to those future profits. And it's also something to keep in mind as you grow your business, right? And I know Manesh is going to talk to how he bootstrapped his organization. And you hear a lot of negative story about, bootstrapping, because it does limit in some cases how quickly you can grow, but it also retains a lot of control to your profitability. So as you're in startup mode, growing your business, get these questions, have some real talk with yourself and figure out, well, how much control am I willing to give up, which is the future profits of your business, besides having to answer to someone. So if we could go to the next slide, and then this is where we start talking about KPIs. And I want to make sure I stick on time here. Great. So referring to that initial P&L in the back of our mind, the same way that you can build out across years projections, you should, using accounting software, run your P&L by month. And it doesn't need to be complicated. You can dump that if you use, market leading software such as QuickBooks. Dump that into Excel. Stuff doesn't need to be pretty, people, right? Excel can do a lot of stuff for you. I don't expect you to get an understanding of the trends and where your business is going by looking at Excel and the numbers going up and down. But what you can do is leverage the power of Excel to do these calculations for you. And this is exactly what we're doing on this schedule. On the left-hand column, there's a few headers such as profitability, liquidity, right? Debt, how leveraged are you? Operational. These are all financial KPIs. And what we do for our clients in our reporting packages, we literally link up using this spreadsheet, the math, right? One of the most important metrics is going to be your gross profit margin. And the math is right there. Well, how do I calculate that? It's going to be income minus cost of goods sold divided over income. And you literally can just type in that formula in Excel for each month and link it to make your life easy to the monthly trend that you just ran out of whatever accounting software. And it gives you a percentage, right? I'm sure like most of us, even though I'm in the numbers business, to look at numbers all day, every day doesn't really inspire a lot of enthusiasm or necessarily tell me a story. So that's where that spark line comes in. So if you look at that 12-month trend, you can go into Excel, create the spark line for whatever length of time. In this case, it's going to be a 6 trend. I like to keep my eye both on the 6-month trend and the 12-month trend. And it just gives you a little visual, right? It's a lot easier, a lot cleaner to look at, using your eye to kind of follow this line, right? If I'm looking at my gross profit margin and it's going down, you got a problem, right? Visually, you want this to kind of stay steady or go up. You should also take into consideration, what line of business am I in? What are the industry benchmarks for gross profit margin? Generally, I like to see anywhere on the low end, I would say a 60% profit margin. Hopefully 70%, if you're talking crazy and you're super lean, 80% would be amazing. But you don't want anything below 60% because that now means I have 60% of my income left. And now we got to go to the bottom, right? I got all my overhead, my expenses, all these things that I'm on the hook for no matter what. That brings us to one of the other most important KPIs, net profit margin, which is going to be your net income divided over your net profit. So after you pay out the expenses over your income. That's what you're left with at the end of the day. So if you're spending way too much on your cost of goods sold, your product, your labor, maybe you have too many people sitting idle, maybe you have just too many people in general and you have to let someone go if you're not pulling in enough income. Or in the case of a product business, you're realizing you're sitting on too much inventory, right? You can't buy too much until it's used. So these metrics are meant to force you to change your behavior because you want to end up with, right? I think everyone in the room can agree, I'm in business to make profit, to make money. A good profit margin, 30%, maybe 20%. Once you start getting lower than that, it's risky. It doesn't feel good. If, you're hitting certain months where unless you have subscribership or recurring income, that's another metric that I think is really important because you can sort of guarantee that this is income that's coming in the door so long as I continue to meet this service. One really important indicator too, or note with regards to these indicators, KPIs don't always need to be financial in nature. I have a worksheet that we'll share with you after this webinar that just lists them out from the financial ones, the non-financial ones. If we go to the next slide over, this is a good example in a construction type business where we have non-financial metrics. And as you can tell, the things that they're talking about, this makes up their weekly scorecard. Get in the habit of, yes, looking at your KPIs that are financial in nature. The problem with financial KPIs is that they're generally reactive. You're looking at them after the fact, right? In tandem, I recommend that you come up with a weekly scorecard. Yes, you can track some financial things such as sales, right? Maybe, did you convert X number of customers? This specifically talking about anything from how many people do I have in my crew? How many leads do I have coming in? How many did I convert? All the way at the bottom is something to keep an eye on for those businesses that don't necessarily have recurring income. Maybe some of us, we invoice our clients and we're waiting on invoice, right? That is critical from a cash flow perspective. that says invoices over 60. So how many invoices are they sitting on that are older than 60 days, meaning they're not getting paid? So if you see that number growing, there's a couple things you need to do, right? Maybe you no longer invoice your clients. Maybe you come up with a retainer policy where you collect money up front and then you invoice them along the way against that retainer that you already hold. Or maybe you have to switch up who's managing AR, right? Get a little forceful, get the tough guy on the phone to chase. But the goal is, with whether you're using financial KPIs or weekly scorecards such as this, and I'm sorry if I can't control the train background noise, so excuse me for that. But it forces you to look at your numbers, look at those other operational areas. Marketing can be a metric that you keep an eye on. Are the number of hits to our website going down? Why? Social media, maybe, that topic's not hot. I'm not going to talk about that thing anymore, right? So get away from thinking it's just financial and get in the habit of forcing a weekly conversation with yourself, your team members, so that you can force accountability and get proactive real time to change behaviors so that you can continue forcing, right, margins up, getting more money in the door, getting more profitable, and also getting lean. Operational metrics. One thing that we do internally in our company, if we could go to the next slide, we look at utilization rates. So this is my company's weekly scorecard. And myself and my COO, we talk about how many leads did I reach? How many did I close, right? What are we upselling? Your existing customers are the best route to get more sales in the door. Other services, yeah, and Manesha's agreeing with me. What other services can you offer to them? They're already your customers. Hopefully they already like you. What else can you do for them? In my organization, we do a lot more than financial services. We bring on a lot of different partners so that we are providing true business development. And our clients love it because they don't have to go chasing around. They trust us. It makes it easy for them to get a robust suite of services that are going to meet their needs and also take their business to the next level. I'm responsible for the CFO metrics, just making sure, we're keeping on top of our numbers. We have cash flow in the bank, capital, because any, decision that you're going to make, whether it's marketing, bringing on new staff, you need to be capitalized. You need at least 3 to 6 months in the bank to make sure that if there's a storm or a recession coming, you can weather that, but also so that you feel comfortable in making some moves so that you can continue to grow your company. At the bottom, right, we want to know some sort of client satisfaction. I have someone on my team that specifically reaches out to our customers to make sure that everything and everyone is happy, because you don't want to wait till it's too late, right? You want to you don't want to bombard them, but stay top of mind. And they're more likely to reach out to you and stay with you long term. And if we can move to the next slide. Awesome. So I'm going to touch on this super briefly. So we've gone through a lot. As promised, we'll make sure that we share with you a quick little 2-page Word document with what some of the key metrics are. Long story short, with attracting outside capital, I think the most important thing is don't wait till it's too late to realize that you have a cash flow crunch and you need to bring in some capital, whether it's the form of going through a traditional lender or an investor. Because the best time to borrow money is when you don't need it. A lender is going to look at your balance sheet, and if they see already you don't have money in the bank, or you're got a credit card debt, up the yang, they're probably not going to lend to you. So it's counterintuitive, but you want to go and sort of stock your coffers when you don't necessarily need it. And if we could go to the next slide, because I want to make sure I'm respecting everyone's time. Yeah, so there's different types of investors. I would say another really important thing to keep in mind with working with either a lender or an investor it's not just about the dollars that they're going to bring into your company. It's going to be about the relationship. Is this someone that can help you grow and that you can learn from? And also, right, with people that we do business with, we want to do business with people that we like, that we care about, right? Because a lot of us spend a good amount of our time working with our teams. So it's not just about what they're going to, bring in dollar wise. It's also those soft skills. What else can they do for you to help you further and grow your business? It's important to consider that as well. And if you're going to go to your friends and family, make sure your pitch is good. Don't show up, kind of like begging or asking for money. Like, hey, show up like boss. Like, hey, I got a great business. I'm going to kill it over the next 3 years. I am giving you an opportunity now to get in while the getting's good. Make them feel good about it, right? So again, mindset comes into play a lot with not only how you run your business, but how you grow it long term and how you build your community and make an impact on your community. So next slide, and I think this brings my section to conclusion. Yep, so just quick hits on the things that you should think about next. If you're seeing operationally, those metrics are telling you you're not doing too hot, you got to drive up accountability. The best way to do that, get your processes, your standard operating procedures in place, hold people accountable. Have a conversation with your people so that you're putting the right people in the right seats. You got to understand what their talents are, what they want to do, right? And also tying it all back, make sure you're in alignment with your vision. So yeah, I think the next slide's my contact details. Yep, some quick resources. If you want to reach out to me, Jessica at bigpickresults.com. That's also our website. We post our newsletters on there. They're super helpful, and there's a lot of capital. There's a big section on grants and capital. So check it out. Email me if there's anything I can do for you. I'm going to stay on and turn it over to the rest of the group. Thank you.
All right. Thank you so much, Jessica, for all of that helpful information. This is a perfect segue. You talked about what story does your finances and your KPIs tell about your business. So now we're going to speak to Patrick from First Citizens Bank. We'll talk about the key things that you need to keep an eye on if you are fund ready and ready to move forward. So Patrick, I'll turn it over to you.
Thank you. And good morning, everybody. Jessica pretty much nailed everything when it comes to KPIs and looking at your profit and loss and balance sheet. When you come to a bank, there's two things that I think customers and business owners have to understand with regards to banks. Number one is, we look at numbers. Numbers are important. Numbers historically, what you're looking to do going forward into the future are important for us to determine the amounts and the creditworthiness of borrowers. However, it's how you do it and why you do it is just important. So today I'd like to talk about the 5 C's of lending. First part is character. When we look at customers' credit history, it tells us a lot about not only just business credit, but your personal credit, what you've done to stay credit worthy from previous lenders. Also looking to see, is there a story behind what your credit says to us as a bank? We also look at 3 years in business and historical profitability. As Jessica referred to multiple times, on a profit and loss, we look at, are you profitable? Are you making money? And how does that relate to what kind of business owner you are and how you do business and what you do for your business? And then important with character is that you can't do everything all the time. I have dealt with clients and business owners that have been so successful. However, they are doing it all by themselves. And when we look at lending, we look at what if something happened to the business owner, what would happen to the business? Because not only are we borrowing to the individual, as a guarantor, we're truly borrowing to the business. And what happens to that business if something were to happen to the business owner? So having an engaged management team is huge. We ask for that when we look for lending. We look at who is your support team, who's your sales manager, who's driving business for you, what you're producing, either it's a service or it's something you're manufacturing, who's in charge of that aspect of the business. Operationally, who's doing the administrative pieces, who's doing the the day-to-day office work, customer service, things of that nature, and who's managing that. And then, as Jessica mentioned, having an understanding of what financially your business is doing and being as part of a holistic team looking at you as a business owner and figuring out how can you drive all those aspects, keep your hand in each part of it, and still give that guidance and still be that business owner that can be move into different perspectives is huge when we're looking for the character of a business. Next slide, please. So capacity. Well, if we're going to lend you money, we're hoping you're going to pay us back. And so we're looking at the ability to repay us with regards to what is your financial situation and how you're expressing or how you're telling us as a bank. So as Jessica had mentioned multiple times, having a clean profit and loss, having a clean balance sheet is important. And then trying to figure out what that picture is presenting to a bank. Now, in some cases, some of these situations, depending on the year, depending on what's going on in your business cycle, some of those pictures aren't necessarily a true assessment. But understanding what those numbers are telling us is huge when it comes to the capacity to be able to return what we're looking for once we lend money, depending on what type of lending we're doing. A little mathematics, we look at a debt ratio. When it comes to lending, we're looking at 1.25 as a debt service. So as Jessica mentioned on your profit and loss, when we're looking at a net income, particularly on your tax returns on the M1 income, what is that income allowing you to service the debt that you have that's on the balance sheet? So if we're looking to do an equipment loan or any type of line of credit, it is how much is that debt dollar, how much in profit, net profits that you're making, it should be $1.25. So it kind of makes it easy. It kind of looks at it and says, okay, is that what, after all the expenses, after everything is done, what your net profit is, what is the annual debt, and does that allow us at least a 1 to 2 to 5 ratio on the debt service? So that's the capacity piece of the C's of lending. Next slide, please. Capital. So this derives directly to what Jessica said on a balance sheet. You could make, and I'm going to pretty much paraphrase what Jessica said, you can make a lot of money. You can make, tremendous amount of money. But if your balance sheet shows that every penny of that money is going somewhere else, either in a debt, you have no liquidity, we are going to ask a lot of questions to figure out what is going on when you make that money. What is happening? Where is it going after you make it? So there's a lot of question when we look at capital and what is the liquidity standpoint? What is the liquidity telling us about the loan request? And then if we are doing a loan, what is that going to do for your liquidity? Is that liquidity being used on a day-to-day basis to fund your operations? And then as business closes, as your business cycle ends, is that being replenished? And how often is that happening? So the balance sheet and your capital are key components for us to understand how money is being used and how it's being cycled through your business. So next slide, please. Collateral. This is important from a perspective of what type of loan are you looking for. So if we are looking at your want to purchase equipment, that's a term loan because it's a long-term or a long-term type of asset. So we're going to match it with a long-term type of term loan. Real estate as well. Now, if we're looking to do accounts receivables or all business assets, we're really looking at a more shorter term working capital, looking to see, okay, what do your ARs tell you? Like Jessica had mentioned on one of her KPIs, what is your turn rate on customers paying you? How long is your business cycle taking to get from where a dollar's placed as an order to coming back into profitability? What does that look like? And what is the security in which we're using to give you the loan? How does that play a major part in how we do it, what we do, and the amount that we do it for? So that's huge when we're looking to understand what you want to do with the money we're looking to give you. And in some cases, clients are looking to do lines of credit for equipment purchases. Well, you know, that's great. However, lines of credit are supposed to be revolving and most banks require that. So in turn, are you going to be able to pay that equipment loan off in 12 months? Because the line of credit will more likely have some type of expectation on bringing it down, pay down to zero. What's the interest rate on it? Things of that nature. There should be maybe some covenants that the bank requires you to keep, and making sure we match the collateral to the type of loan that we do. So that's really, really important to understand and explain to your bank and to your banker, this is what you're looking to do with the money from a perspective of collateral. So next page. Conditions. So this being the final C of lending, it's the whys behind it. So numbers tell us what financial picture you're telling us that will allow us to say, yes, we believe if we give you this loan, you in turn will pay us back. But the conditions on why are so crucial to how much and what we're going to do for you as a bank. So why is the loan needed? Are you doing this because you're struggling and the loan is going to inject some capital in a business model that seems to be struggling in itself? You know, like Jessica had mentioned, giving loans when you need it is difficult for a bank to do, because at that point, your picture that you're painting us is saying that your business might not be able to survive if you don't give us this loan. Therefore, it puts a weight on where we're looking for you to be able to repay us. So why you need the loan? If the loan is to increase inventory, if the loan is to increase equipment, if the loan is saying you are currently using your liquidity to fund your own growth, then we could be that funding that you need to continue to grow, and therefore using your liquidity for other aspects of your business that will continue to have you grow. And it could be that you're going to use your liquidity to hire more employees, so therefore you need our line of credit to help you through the business cycle for your clients that they have a 30-day term. It could be that you're growing and you needed more equipment, from desks to computers to large CNC machines, because the capacity you hit with your business allows you to go ahead and make that move. So things like that we take in consideration when we're looking to do the loan. And for you to, as a customer or as a business owner, to explain that to us is crucial. How is this business going to benefit from the loan? So that is a big piece of the condition of why we would give a loan, is because to have us mathematically know or financially know what you're going to do with the loan, and to see how it's going to grow profit margins, how it's going to grow revenue, how it's going to, maybe a new equipment will help you with more lean type of employees and overhead. So really understanding the benefit of this particular loan to your business and articulating that to a banker is very helpful and helps you move along when it comes to what you're looking for in a bank and what you're trying to do and accomplish with the loan. How do you know what's going to work and why now? Those are two questions that we really, as bankers, never really get to in some cases, but make a huge impact when we talk to underwriters. How do you know it works? Plays to your expertise as a business owner. This is where you get the opportunity to explain to us and hopefully have us understand what you already know as a business owner and in your success and why you even went into business. How do you know this loan and what you're doing for it will work? And that's important to understand and to be able to articulate to a bank, so we would understand that when we do this, we have a set of confidence that not only are we going to be repaid, but that it's going to do for you as a business owner and your business what you're expecting it to do. And then more importantly, why is now the best time to do what you're looking to do with this money? Why is it? Is it because you anticipate a growth? Is it because you're at a point in your business cycle or your business that if you want to take that next step to grow revenue because you hit a capacity and you need to start to look at things and say, okay, now is the best time for me because of this. And explain to a banker and to a bank helps us to explain to underwriting, this is why today is a good time to do it. Rates obviously are important. Looking at your loans and saying, look, I'm paying high interest rates for maybe that you were a startup and you went through SBA or other type of financing, or even some additional capital of friends or family who own ownership, and then saying, you know what, now is a good time for me to pay back that capital and own 100% of my business. You know what, I've graduated from a startup of 1 to 2 years, and I've graduated to a 3, 4, 5-year company. I've learned a lot through that time, and now I'm continuously being profitable. And what we are going to do to help do this now? Why is it now? And it's important to understand that holistically as a bank, to be able to say this customer is a good customer for us to lend this money to. Next slide, please. In conclusion, financial understanding of your business model is key. As Jessica mentioned many times, having clean financials is huge. Having the ability to articulate those financials is huge. But more importantly, understanding and being able to explain to a bank how this affects your business model and where your business model drives those financial results. Staying focused on credit and how it's used. If you have got good credit, pretty much anybody is going to give you a credit card. But it's important to understand what the credit card is going to be used for, what your credit, having a home, making sure that when you have business credit on your DMB, to making sure that every aspect of your credit is tight, it's being used appropriately, and is being paid attention to, because that is probably the foundation of where banks are going to look for first. We pull credit before we even do financial analysis, and that credit is a huge piece. So stay focused on that. Save when you can and utilize liquidity for growth opportunities. It is important to put money back into the business, but it's also important to save for those rainy days. Jessica had mentioned 3 to 6 months liquidity in being able to run your business is a good cushion to allow yourself to save that liquidity. From a bank's perspective, we see that you are diligent in saving money and being able to say, hey, if something does happen, I can go to this liquidity if I need to. What you buy with the loan is important. Once again, being able to explain to a bank what you want to buy, why you want to buy it, and the understanding of what it's going to do for your business is important to explain to a bank and to understand it as a business owner. And then the whys of the loan request, telling a story to a bank can offset a lot of what financial information tells us. COVID just occurred, the pandemic just happened, 2020, the majority of people had a story to tell what your financials said in 2020. A bank will take a look at that on a case-to-case basis and look at it and say, hey, everybody had to go through this. What did you do as the character of your business, as your knowing how and why things happen, and how your management team and yourself was able to push through, and seeing 2021 and 2022 looking to recover very quickly is a huge opportunity of the whys of why banks will look to oversee why we would do a loan and how we would do it for you. So ultimately, we wanted to say banks are there to be able to help you get through a process in which you are growing or which you need to reassess your business to say, hey, a bank can contribute, or I've grown into more traditional funding, and that's what we can do for you. And hopefully this will help. And I'm excited to if there are any questions afterwards, or you can directly contact me at patrick.rodriguez, RODRIGUEZ at firstcitizens.com. And thank you very much for your time.
Thank you so much, Patrick, for all of that helpful behind the scenes tips and information. It's so crucial to understand and how to articulate your finances. So now we've heard from an expert from behind the scenes with the numbers and key things we need to track. We've heard from a financial background vice president of First Citizens Bank on the key things that we're looking for our business. And now we're going to speak to a business owner who has gone through all those steps and who can speak from experience what it's like to get funding. So we have Manish, the floor is yours.
Thank you, Shailon. So let's dive into the presentation. So it was great. I think, Jessica and Patrick has set the stage for the right set of information, and I'll use their content as a reference when I kind of walk through my story. So I need to have, it's been 10 years I've been running this company. So essentially, Sharon, we can go to the next slide. Essentially, we are a full service white label digital agency. I started this company back in 2012. We are currently having a team of 160 people. So I built close to $2.4 million annual recurring revenue business in just last 3 years. And mainly we did 3x growth in last 3 years. Our primary target market is the US and Canada, and essentially it's 100% bootstrap business. So I'll kind of work directly into the four most important things, right? What makes your business eligible to get the funding with kind of seamless experience. So Sharon, let's get into the next slide directly, and I'll start using that. So a little bit about me. I have over 15 years of experience in digital marketing. I started 3 ventures, including E2M. I lost over 100K in sitting down a couple of ventures, but learned great lessons, which I would not have learned otherwise. Currently running E2M, the only business I'm running, which is successfully 100% bootstrap and profitable. And I have been a contributor on a lot of industries, leading publications. Let's get to the next slide, please. So this is where I would like to focus talking more about that. So I think whatever way you try to get the funding, essentially in a traditional way or a private equity or through an organization like Founder First, which is focusing on RBF, which is a revenue-based financing, you have to understand essentially all they care about getting their money back, right? So at the end of the day, the primary thing they want is, if we fund your business, will you be able to pay us back on time, right? That's essentially, that's what everyone care about at the end of the day. So in last 10 years, first 7 years, I ran this business in the most traditional way, where we are like, we are in a service business. So our revenue, our business model was more of like a traditional business model, which is where we used to work on a project to project basis, where imagine like clients are getting on board, we look at the requirement, we give them a quote, they approve, and we do it. And we get paid like 50% upfront and 50% upon the completion. So that's kind of traditional model we built. And 3 years back, I kind of like realized that, okay, how can we like pivot our business model to build a recurring revenue based cash flow, right? And that's where like 2000, towards the end of 2018, I realized, and we started heavily pivoting our business model, where we switched our business model from a fixed cost model to a monthly subscription based. So we productized our services, where same client, same service, just like pivoted the business model. So what we started doing it, like we started showing a lot of benefits to our clients that, hey, we are doing business using this pricing model. We have pivoted, we are introducing a new pricing model. Essentially, you are going to pay the same amount, same like price, but in a different way, represented in a very, very different way. So one thing you have to make sure that when you pivot the business model from like traditional pricing to a like, recurring, like monthly subscription based pricing, you have to make sure that it should not hit to like more money to your clients, because if they see, they are going to pay more than what they were paying you earlier, then obviously they will like, walk away. I mean, they will obviously find an alternative. So you might lose their business. So you want to make sure that you do not, you make sure that you have to explain them in the most subtle way, where at the end of their cost is not going up, right? So that's what something you have to make sure. One thing you will realize when you pivot your business model, your pricing model from a like traditional business model, which is like, let's say if you are in a service business, then project to project, or like time and resources, like material base, which is sort of like you are doing on an hourly basis, which is ad hoc basis, or let's say ad hoc basis, then you want to make sure that you will realize that when you switch to a subscription business pricing model, you will definitely see increase in your profit margins, because now it's sort of like, you are selling your service as a product where you have a guaranteed revenue every month, versus a project-based revenue where you are only generating revenue whenever your clients have a project, right? And this will help you to reduce a lot of bad debt, because what happens that, imagine you are dealing in a typical pricing model, which is a project to project basis, where you are generating 50%, you are raising a 50% invoice at the start, upon the signing contract, and rest 50% you are getting paid once you deliver the project, where the chances are most likely, could be a less likely, but most likely, where the project could not be like, it will take too long to complete the project. That will affect your cash flow. Sometimes client will lose the interest. They will put the project on hold. That means, what does that mean to you is like losing the rest 50% revenue. Sometimes, there are some hiccups in between, and you might like, write off those 50% as a bad debt, right? So I think first thing, so there are two types of audience over here. One is someone right now, out of all attendees, either you are running a business and you already have a you're already generating revenue. And the second type of businesses are here who are about to start your business. So I would say to both types of businesses, identify, let's say if you are offering services right now, identify how can you productize your services and generate a recurring revenue. Like you have to do a lot of research. It must make sense for your clients as well, that you're offering a recurring revenue. So my first thing is like, look at your business, take a step back, right? And if you do not have any recurring revenue right now in your business, then there is a problem. Because essentially, like Jessica said, like Patrick said, they really want to see like how they are going to get their money back, right? Now, when they see a recurring revenue in your pricing model, that gives them a confidence that, hey, like, okay, this business is getting a stable recurring revenue, and that gives them a confidence to fund the business. So that's the very most important thing, first thing I'll say, because when I did this exercise, they asked me all these things that, okay, like since how long this customer has been working with you? What's the monthly average, billing are you doing with this customer, right? So that's the most important thing that you should really think about pivoting business model in case if you are not generating recurring revenue. Second most important thing, you really have to look at your churning ratio, new business versus retention. So like Jessica mentioned it, right? So I'll use this quote. It's so easy to sell to your existing clients rather than finding the new one and selling it to them. Okay. So we often, so your existing clients are the lowest hanging fruit. You have to make sure that your retention has to be really high compared to what new business you are adding, right? So I would say like, your retention has to be above 90%. It should not be less than that. So out of 9 customers, out of 10, 9 customers, 8 to 9 customers must be working with you, right? As long as, there is a win-win situation. Let's say if your clients run out of budget or if it's not the right fit, then it makes sense. But you should look at always the ratio, like how much new business you are adding compared to the retention. And your retention has to be really well. This is a really good sign when lenders are looking at your financial, right? So when we raised our funding, they really looked at, okay, this company has a really good retention ratio. And they really see a lot of our customers have been working with us since last 3 years, and they have consistent business since last 3 years, which gives them a confidence that, okay, this company has a really good product or service which their clients believe in and have been working with them since long. So you really want to make sure that you should have a lower churning ratio where you should not be losing clients every now and then. And it's kind of like, let's say you lost 5 clients in last quarter and then you added 5 new clients, right? It doesn't make sense because it's kind of like the same thing. So that's really a best thing you really want to look at. Third most important thing is referral should be the major channel of acquiring your new business. So I would say let's say if you are already in a business right now, then you really want to look at the source of your leads, like Jessica also spoke about that, right? You really need to make sure that you should be getting a lot of business through referral from your existing clients and through word of mouth, right? Which is kind of like proves that your product and service is working, because the best way to generate business is through word of mouth, right? That way, you are not relying on cold channels, you are relying on your existing clients. And that relates to the point number 2 is making sure that you have a higher retention ratio, because I'm pretty sure if you have a higher retention ratio, they will most likely going to recommend you to other people, right? One of the ways related to point number 3, if you really want to know this thing, you should run an, if you are in an existing business, if you are already having a clients, I would recommend you to run NPS survey, which is a Net Promoter Score. So what is NPS survey is like you are gonna reach out to your existing clients and gonna ask them 2 questions. How how frequently are you going to recommend us to your friends or colleagues or people in your network, right? How would you rate our services or product, right? And by that way, you will get to know exactly how likely your customers, existing customers, are going to refer to you, to your, and we did not have this NPS survey back then when we raised the funding. We just did it recently. But when you are raising the funding, use this as a part of your pitch that, okay, this is our NPS score, right? And make sure when you do the NPS survey, nobody is going to, you will not all of your clients are going to fill up that survey. So it would be around like 50 to 60% people will be filling up that survey, but that will give you a really, really good idea. Like, what's your NPS score, and use that as a pitch when you kind of like, do that thing. So yeah, I got it like Salon. So we'll wrap up very quickly. The 4th thing will positive cash flow. Jessica and Patrick already spoke about that. So make sure about that. Again, maintain financial hygiene. So one thing I would say, like as a business owner, like you always like, rely on your CPA or bookkeeping people to look at your financial. But I would advise that you should have a really, really good idea about your financial hygiene, and making sure, your financial look really, really great. Just do not like, have your CPA or bookkeeping person to take care of everything. You should also really know about everything. So when we raised the funding, there were tons of questions I was being asked, and I was able to answer those questions immediately because I understand our financial really well. And that puts, lenders more trust in you, that you as a business owner have a really good understanding of finance. So I think that's it. That's it from my end. Since we are running short of time, I'll be happy to take questions. You can always reach out to me by email. If you have any questions, that's the best way to reach out to me.
All right. Thank you so much, Manish. This has been a wonderful, wonderful presentation today. I always tell everyone who comes to our webinars, we never have enough time. There's always so many wonderful questions that are sent in before, during, after. So never fear, everyone who is on the webinar, all of this recording, as well as takeaways, contact information will be sent directly to you. So all those really burning questions you have about your business, things you heard you're unsure about, you need clarity, feel free to reach out to our panels. They are happy to help you. And before you leave as well, make sure to follow us at foundersfirstcdc.org. That's foundersfirstcdc.org to know about our next webinars, to know about our grants that we have coming up, as well as our accelerator programs. Plenty more opportunities for you to not only learn, but have access to these great connections like we have today, and access to capital. So thank you all for attending. I want to thank our panelists, and you all have a wonderful day.
Thank you, gang.